Okay, ladies and gents, thank you very, very much for holding for those who have been in quite early, eager to hear all about financial planning. So welcome to everyone to IPF's Financial Planning for Doctors webinar. We're delighted to have everyone on the call. We had such a high subscription, which is great to see so many people taking the time out to take control of their finances and get this information. I suppose, especially in an occupation where all you do is look after everyone else, it's very important that you take that time out for yourself as well. So look, I'm going to talk you through the types of things that we're going to cover tonight. I suppose you are all familiar. It's in our name. We'll be discussing pensions this evening. We'll be discussing taxation, wealth creation, and also about in retirement. There's a few other topics that will come up throughout the presentation that may pique its head. But one thing that I would recommend for everyone to do is we've opened up the chat box at the bottom there. I was just wondering if people can test it by just saying hi, just so we know whether it's operating and functioning. And Kieran, if you want to let us know.
We do. Yeah, Anya, this is recorded. So if anybody does have to jump, we'll try and keep it to within about 30 minutes, folks. I appreciate you might have little people to put to bed, or even just get a bit of dinner or whatever it might be. We'll try and keep it within half an hour. But Anya and anybody else, if you do have to jump, it is recorded. Okay.
Brilliant. So look, I suppose we're going to keep the chat function open because at the end of today's presentation, we're going to take 5 to 10 minutes to answer as many as we can. However, following today, we will be carrying out courtesy calls to everybody that has RSVP'd. There may be some people that couldn't get away from the wards even today to join us. And what we will be doing is we'll run through a few questions with you and we'll see if it makes sense to book in for a financial consultation. Kieran, my colleague here, will be talking to you a little bit more about that further on in the call. But firstly, I want to welcome everyone, and I hope you all get something out of today's meeting. So, just to start off, sorry, function. Yeah, there we go. Just to introduce ourselves and IPF. My name's Wendy Thompson. I'm a senior financial planner at IPF. I'm joined with my colleague in a matching shirt, Kieran MacDonald-Byrne. And I've also got Ryan Flood here, who is from our mortgages team, who's going to say a piece at the very end. So we're going to split the presentation in three, everybody. I'll take the first part, I'll pass you over to Kieran, and then we'll lead on to Ryan, who's going to discuss new mortgages and switchers, etc., and where you can save money. Just a little bit about the company that we work for, Irish Pensions and Finance. For those who don't know us, we're an Irish-owned brokerage, and we're based in Clonee in County Meath. And why we're familiar to a lot of people probably on the call is we run the group AVC scheme through the public sector. The HSE being one of the schemes that we deal with, one of our biggest schemes. And this is something that traces back to 1993, when we've been given these presentations around pensions and offering advice to your colleagues in the health service. We have a team of financial planners. We've over 70 financial planners and over 40 or over 30 back office staff. Experts within the public sector scheme, we'd love to say. And one thing that we really pride ourselves in is that we've over 30,000 clients. And we hit a milestone quite recently, last year, just before Christmas, of 1 billion in funds under management. So I suppose, look, I'm working with the company over 10 years, and I've been dealing with a lot of my clients for a very long time. I think, suffice to say, managing 1 billion in assets shows the trust that we've built with our clients and the ongoing service that we've been providing. As I said, I'm 10 years here, so I obviously love the job, along with Kieran, who is part of the furniture as well now at this stage. But I think a great way for you to find out about the type of service that you can get from IPF is having a look at our Trustpilot. We run monthly snapshots out to our clients to see how they got on with their financial reviews. That is not only new clients, It's also clients that we have on our books for a number of years. So you can see the difference between the reviews between someone who has just joined, maybe had their first consultation, might have been a little bit daunting, and you've also had the people that have been looked after all the way through. Another thing that we pride ourselves in, a huge cohort of that 30,000 people, clients, we have a lot that are actually still clients that are retired clients, which we really pride ourselves in, and the service that we offer post-retirement, which is equally as important because you're no longer earning in retirement and you need that extra bit of advice. So I'm going to talk you through the objectives of today and the agenda that we're going to cover. I'm going to take the first part of the presentation and I'm going to talk you through the basics of the main superannuation benefits that you've got with your employer. I'm going to talk to you then about the benefits that you're going to receive at retirement. We're just going to use an example, myself and Kieran. And then I'm going to pass you over to Kieran, and Kieran's going to talk to you about how AVCs work and the recent changes in the standard fund threshold. I think this is something very much a hot topic over the last number of years, and especially in the last year, the subsequent changes Kieran's going to talk to you about and what your options are around that if you're under, but also if you're over the standard fund threshold. We'll also talk to you then about the benefits of using a financial planner. I think suffice to say, you know, you're experts within your realm. We pride ourselves in the service that we're providing to everybody. And this is something that we stand tall on in terms of what we can offer you as financial planners. So I'm going to kick over to, you'll see here throughout the slides that there's a QR code, okay? Everybody can scan the QR code as we go through the presentations. What that will do is it will put you on a priority list for a callback. Now, everybody that has RSVP'd will be called because we'll give you a shout. We'll find out how you got on at the presentation, get a bit of feedback, and go through any questions that you may not have had answered, because there may be questions that you don't want to ask in this realm. We will also figure out whether it makes sense to book in for a financial review and whether you'd benefit from a financial review. And how we do that is through a 5-minute screening call post the presentation tonight. So you can work away at that as you see it. You can use your phone, but as I said, we'll be in touch irrespective. Okay, so I have the joy to talk you through the superannuation scheme and all the benefits that you get with work, okay? So as you're probably aware, over the years that you've been working, there's deductions that come out of, normally speaking, the right-hand side of the payslip, okay? You see your big tax bill going out, okay? But there is deductions that give you all of these benefits, okay, which equate to your superannuation scheme. And the first two are your pension and your lump sum, okay? So your pension being your regular income for the rest of your days in retirement. And that's the thing that will support you and give you the lifestyle that you want in retirement, okay? You then get a lump sum, which is a once-off payment from your employer, okay? Again, that's something that we can calculate and show you in an individual consultation. However, myself and Kieran, needless to say, we've prepared slides to go through both the pension and the lump sum as an example on the next two slides. So really what I want to focus on this slide is really the last three benefits, okay? So you can see here you've got an illness benefit, okay? So your illness benefit is if, God forbid, you got sick, what happens? How do we pay the bills? What is there, okay? Now, a lot of people that we sit down with on an individual basis may not know the fundamentals of what's already there, okay? So what you all have individually in the public sector, okay, is 3 months full pay, followed by 3 months half pay over a 4-year rolling period if you're out sick. Now, that can be used up, obviously, if you've used up your allowance within the 4 years, okay? There is then another benefit tied to that. There's an ill health early retirement benefit. So God forbid, if you are that sick that you're unable to return to work and you've been signed off on ill health ground, there is a pension and a lump sum that is payable to you early. Now that is based on the service that you've accrued to date and there's an additional little calculation that we can do to give you an estimate of what that would be. Myself and my colleagues, when sitting down with you on an individual basis, we can show you what that looks like and stress test whether it's going to cover the day-to-day bills. Now, Kieran's going to cover a slide further on and elaborate on that a bit more, because I suppose it is very important with any financial plan that if you're aiming to achieve anything, whether it's saving, whether it's anything, that your income is secure. It's your biggest asset. Okay, so again, Kieran's going to talk to you about that and what your options are surrounding your illness benefit. The other area then is your death in service. So some of you may know that you have a minimum of 1 times your salary as a death in service benefit. So it's like a form of life cover. That can be up to 2 times your salary, depending on when you join service and what scheme you're on. Twinned with that, there's also another benefit. There's a spouse and children's benefit. So if anything were to happen to you, now this applies not only in service, but in retirement if you pass away. There is a pension payable to your spouse for the rest of their days. And there may be a pension payable to your children depending on their age, normally up to age 22. Again, this is something that myself and my colleagues at IPF will be able to show you. But normally speaking, when we sit down with people, they normally have some private cover already in place. And 9 times out of 10, when we have a look at the cover, a lot of the time, the benefits that you've got with work have not been factored in. Suffice to say, today we are talking about pensions and we're talking about your main superannuation scheme, excuse me. However, we would like to speak to you about a proper, robust financial plan. Everybody's goals is different and everybody's needs are different. And that's something that we can elaborate on an individual basis. Okay, so I'm going to jump over. I mentioned the first two, pension and lump sum. So I'm going to talk you through here just an example of the changes to the public sector scheme over the years and the different contracts that apply. Okay, so Kieran, I'm going to use you as the example. Me and you started on the same day, right?
I remember it well, Wendy. I remember it well.
Yeah, great. So Kieran was sitting beside me. Both of us have retired, right, on a salary of €270,000. Okay. The first scheme that you hear of is people that joined before April 6, 1995. And they pay, when you look at your payslip, you can see D1 or B1 class PRSI deduction on your payslip. Okay. What that means is that you get your pension from one source, and it's your employer. Okay, so this is what they call the Rolls-Royce pension in the public sector. Okay, so myself and Kieran walk out the door with 135,000, half our salary as a pension for the rest of our days, because we have our full service and we get it from one place. Per Ryan, he started a little bit later. He retired on 270,000, same salary, but he joined prior to January 1st, 2013. What happened in 1995 was they integrated the employer pension with the state pension. So Ryan doesn't get 135,000 as soon as he walks out the door. What happens is Ryan gets 119,956 when he retires, and he gets the rest from the state when he's entitled to it, circa about 15 grand. Okay. Now, what happened thereafter is on the 1st of January 2013, there was a change completely to the pension calculations. What they decided to do was they were going to base the contract on a career average salary. So, though, let's say I joined on this scheme, just for example, I retire on the exact same salary as the boys, okay, 270k. But because I joined on the later scheme and they factored in the career average salary, I actually retire on 99,900. Okay, so you can see the subsequent changes as time goes on, that the pension is slightly lowering. Not only that, the goalpost is being pushed out in terms of retirement age. Okay, so I'm going to talk to you a bit more about the lump sum. Okay, so this is a payment made as a whole. So, all right. Okay, so this is a once-off payment. Okay, so using the exact same example. Sorry, Kieran, we started on the same day, used the wrong slide. We retired with a salary of 270k and 40 years of service. Kieran worked the full throttle. I had to take time out. I had to reduce my hours. I had commitment to family. I worked abroad. And as a result, I only had half service. Okay. Using this example, Kieran is the purple column and he joined pre-2013. He gets a lump sum of 405,000. Because I only have 20 years, I get proportionate of that. I get 202,500. So, of course, I'd love to have something like what Kieran has. Kieran's going to talk to you about whether it makes sense to boost your benefits up to what Kieran has later on in the slides. Per Ryan joined after January 2013. Okay, using the exact same scenario, if he had his full 40 years because of career average on a 270 final salary, he would get a lump sum of 345,000. So quite a difference between himself and Kieran. If he worked half-time, similar to myself, he would retire with a lump sum of 172,500. So you can see there's quite a difference between how the lump sums are depending on your years of service and depending on the contract that you are on. So something that, there's a reason why I didn't say tax-free on the previous slide, because the lovely revenue have rules about what we can have tax-free in Ireland when it comes to pensions, okay? So we've used an example here. You might see on the revenue website that the first 200,000 of retirement lump sums that you take from all sources is tax-free. The funds above that, from 200 to 500, are subject to 20% tax. And any excess over the 500 is subject to 40% tax. So I'm just going to stick with the example of the 270k salary, because most consultants are retiring. They're thereabouts 270, 277 quite recently. And I know we've got a few increases coming up this year with 2 more. We're going to stick with the example of Kieran here, if everyone can stick on this one, right? So 270 salary, Kieran is entitled to 405 as a lump sum, but because his lump sum is 205 grand above that 200k that he's allowed tax-free, he has to pay 20% tax. So he has a tax bill of 41,000 euro. And as a result of that, he comes home with 364,000 into the bank account. Needless to say, if his wife is listening to this call, she's going to be staying with him into retirement, because he's got a healthy lump sum there carrying it into retirement. So I'm going to pass you over to my colleague, Kieran MacDonald-Byrne. He's going to talk you through the standard fund threshold, which is very topical. And I appreciate everyone popping in their questions up to date. Kieran, over to yourself.
Thank you very much, Wendy. And again, thanks everybody for your attendance today. So, okay, standard fund threshold, otherwise known as the SFT, very, very topical. I'll assume that most of you have heard of the standard fund threshold. But what is the standard fund threshold? Well, look, simply put, it's the total value of all of your pension benefits from all sources. So that includes your HSE pension, any AVCs, PRSAs, personal pensions. What happens is, at retirement, they're all added to give you one overall fund value. Okay. Now, if you look below, you'll see a column there where you'll see figures from 2025 down to 2029. Right now, today, the standard fund threshold is 2 million euro. So if your accumulated pension values exceeds 2 million, you'd be liable for something called chargeable excess tax, CET. Okay. Now, there's a bit of good news. And the good news is that the standard fund threshold is rising by 200,000 every year over the next 4 years up to 2029. So today it's 2 million. Fast forward to 2029, it's 2.8. So that allows you to earn an extra 800,000 in retirement without having to pay the chargeable excess tax. And from 2030 onwards, the SFT will be indexed to average weekly earnings. Okay. Now, this is very important because you might have someone who is due to retire in 2026. But if they, and please don't shoot the messenger, if they defer their retirement maybe for 1 or 2 years, that'll increase their threshold from maybe 2.4 up to 2.6 million. So again, sitting down with an advisor and allowing us to do the calculations to show you the capital value of all of your combined pensions, we'll then be able to establish, number one, if you have a chargeable excess, if you're going to breach the standard fund threshold, and if you are going to breach the standard fund threshold, what are your options? Suffice to say, the vast majority of hospital consultants within the HSE, your main scheme alone is going to push you very close, if not over that standard fund threshold. Okay. So I have a couple of examples here. The first example I'm going to show you is somebody that has scope to either continue making private pension provisions or to start making private pension provisions. In this example, we're looking at a consultant retiring on a salary of 270,000. They're taking early retirement, which you're all allowed to do, by the way. You know, you can all retire up 10 years prior to your normal retirement date. In this example, assuming they're retiring after 2028, they've got a threshold of 2.8 million. Okay, they're the A1 class of PRSI, and they joined after 2013 with 30 years service. Okay, so in this example, they're getting a net lump sum of 251,000 and an annual pension of 63,696. The capital value of those two pensions combined is 2.17, which leaves just over 600,000 that you can now fund for by way of an AVC or PRSA, a private pension effectively, in this example. I will note what's highlighted in red. In this example, this person is retiring on, say, 63.5, nearly 64,000. Very, very good pension, but, you know, make no mistake about that. However, it's 24% of the final salary, 270. Effectively, that's a 75% pay cut. And that happens overnight. And this is where, you know, working with a financial planner to try and soften that blow can, you know, can really be to your benefit. Okay. So in this example, we're going to look at maximizing. So how do you maximize? We said there's a shortfall of just over 600,000. What do you do? Well, Wendy said at the start of the call, we're one of 2 providers that actually facilitate a group AVC scheme. For those that don't know what an AVC is, it's an additional voluntary contribution. It's effectively a voluntary pension. And if you want to, you can set up an AVC through IPF to enhance your pension and lump sum. So how do they work? You pay through your wages, nice and straightforward, okay? You get tax relief at source. I'm going to talk to you about tax relief now in the next slide. You can make regular contributions to your salary, or you can bypass your employer and you can make lump sum contributions, or a combination of both. Now, why does it make sense to do lump sum contributions? Typically speaking, we'll see doctors who have private income and therefore have a private tax bill. Okay, so your tax through the HSE is all done through payroll. If you have any private income or if you have rental income, your accountant will invariably tell you your tax bill is X amount at the end of the year. So what you can do is you can do a lump sum payment. You'll be entitled to tax relief on the lump sum, and that tax relief you're entitled to, you can offset against your private tax bill that you have either through private income and or rental income. Okay, the money has to be invested, which is a very, very good thing. Typically speaking, pension funds, you know, you put in X amount and over time they tend to grow. You get the benefit of compound interest. And there's charges as well. Okay, now the charges, we're very explicit and very clear with the charges. When we meet with our clients, we'll give you charges verbally. We'll write them on a financial planning document. We email them, and you also get a copy of the charges in your policy document. So very, very transparent. But it's not a one size fits all. It depends on the type of pension product, your age, your term to retirement, and the amount that you're willing to put away on an annual basis. Suffice to say, the charges are there, but as I said, we're very, very transparent. So tax relief. So I don't know if you guys know this, you probably do, but you will all, well, I say you all, the vast majority will pay well over €1 million in tax throughout your working life. Substantial amount of tax, okay? And pensions are the most tax efficient way to create wealth. You know, there's no getting away from it. So we have an example here that, you know, we've established you have a shortfall of say 600,000 before you reach the 2.8 million. if you were to put 300 net, so you're paying 300 out of your pocket, the government will claw back 200. If you're paid we'll say you're paid fortnightly, so you pay 300 every 2 weeks. The government's going to claw back 200 off your tax bill, and that 200 gets added to your net 300, meaning a gross contribution of 500. If my maths is right, 200 over 26 weeks is 5,200. In this example, you'd claw back 5,200 in tax by way of an AVC. This is just an example. Obviously, you could do a little bit more, you could do a little bit less. Okay. So the last example we looked at is somebody that has scope to make additional or private pension provisions, AVCs, as Peter says. The next example I'm going to give you is someone that shouldn't be doing AVCs, or, if you've got any private pensions, you'd need to stop them if you fall into this category. Again, consultant earning 270 at retirement. They're retiring at age 65. They joined pre-2013 and they 40 years service. So 40 years is the most you can aim for. In this example, they're getting a net lump sum of 364,000 and a generous pension of 119,000, 120,000. Okay. The tax liability, because they've exceeded the 2.8, is 722,000. The capital value of these two pensions, and just to make a point on this, that capital value is just assuming a HSE pension. That doesn't take into account any private pension. If, for example, you had €1 million or €500,000 in a private pension, suddenly your capital value is 4 million euro. But coming back to this example, you've no private provisions at all. HSE pension alone is giving you a tax liability on 722,507, meaning a tax bill of €250,000. It's quite substantial. I had a client recently who retired a couple of years ago, happily, and he had an outstanding tax bill of over €400,000. And unfortunately, he did nothing wrong, in my opinion. The issue that arose was a lack of advice. And this is something I really want to hit home today, is that, if you're sitting down with someone from IPF, it's imperative that, we will reach out to you every 12 months. And it's imperative, in my opinion, that you avail of that review, because there can be so many different changes, whether it be legislative changes, changes in governments, budgets. I mean, if you're 30 years away from retirement, how many budgets, how many ministers of finance, how many legislative changes could impact your financial plan, your pension plan? And we're on hand. We might be able to do anything to change it, but then again, we might. If I go back to the example, had I met with my client who had the 400 grand tax bill, had I met him 10 years prior, I would have been in a position to tell him, look, stop paying into that pension, redirect it into something else, and we would have been able to reduce the tax bill. Okay. In terms of paying that tax bill, there's 3 ways. I'm not going to get into it today because it is quite complex and a little bit nuanced. But suffice to say, the tax bill will have to be paid. There's 3 ways to pay it. But if you're sitting down with one of the advisors at IPF, the first thing we'll do is establish, do you have a chargeable excess tax? Do you have a tax bill? Have you breached the standard fund threshold? If so, by how much? And then we'll talk to you about your 3 options. We'll outline option 1, option 2, option 3, and then you'll decide what you feel is in your best interest to try and mitigate, reduce, or offset some of that tax bill. Hope that makes sense to everybody. I know it's a little bit complex, not complex, but it's a bit technical, shall we say. I just want to touch on GPs, if there are any GPs on the scheme. So your public sector pension ceases to exist. This is assuming you go onto the GP scheme, so you're leaving the HSE. Now, when I say cease to exist, let's say you're in the HSE, you're doing your NCHD for however many years, and you're on the HSE superannuation scheme, say for 10 years. But that 10 years worth of superannuation is banked. You don't lose it because you've left and you're gone onto the GP scheme. You will still have that benefit to draw down, but it's just parked, if that makes sense. Okay. But once you've left the fold, pension planning is entirely up to yourself. You have to kind of take the bull by the horns and you have to start funding for your own pension. Okay. Now, we've done an example here for someone that's 30 years away from retirement. If you wanted to pay yourself the equivalent to 60,000 per annum, try and get yourself in line with your colleagues in the HSE. You'd have to pay about 1,500 a month over 30 years, and that assumes a modest growth rate of 6% every year. That 1,500, by the way, you get tax free for 40% on that, so the net would be €900. So you pay 900, but 1,500 goes in. But that's what you're looking at over 30 years, about 900 net, 1,500 gross per month over 30 years, assuming 6% growth rate. That would give you the equivalent to about 60,000 per year, and that's trying to get you in line with your pensions in the HSE. And the GMS scheme, for anybody in the GMS scheme, the HSE will make contributions to your pensions, but the HSE contribution to your pension will only will only come from income derived from medical card holders. So if your book of medical card holders only equates to 25% of the overall book, 75% is coming from private income and the other 25% is coming from medical card holders. Well, the HSE will only contribute to the income derived from the medical card holders. Okay, now I just want to have a quick look at the chat box. We have a couple of questions there. I am going to come to them at the end if that's okay. But again, I know these are quite technical slides we've gone through. If anybody's any questions, throw them in the Q&A and we will come to them at the end of the webinar. Okay, really important this, protecting your asset, okay? So apart from your health, I think most people would agree your income is probably your biggest asset, okay? So we would advise all consultants to at least have a conversation about income protection. And income protection is an insurance vehicle that effectively allows you to insure up to 75% of your income, okay? Now, you probably don't need 75% of your income. What we would do as financial planners is we would sit down on a consultative basis and we'd assess what your outgoings are on a monthly basis. Do you have children in private education? Do you have you got a high mortgage? Have you got, how much are your utilities? How much are your groceries? And what we try and figure out is how much do you need to keep the show on the road, as it were? How much do you need on a monthly basis to make sure all of your utilities are paid, your mortgage is paid, and you can still educate your children? You can, as I say, insure up to 75%. It may not be necessary for yourselves. As I said, we'll sit down on a consultative basis and we'll establish what are your monthly outgoings, and that's the figure that we would aim to do. Okay. You can see, just go back for 1 second, Wendy, if you don't mind. Just one point I wanted to make was the average length of claim is 6 years and 9 months, so nearly 7 years that people claim from. I do have a client who's actually claimed twice, would you believe? She had heart surgery and she also she broke her back. She fell downstairs and she claimed twice on the plan. Single mother, and she could not praise income protection anymore because one thing she didn't have to worry about was, putting food on the table and meeting mortgage and monthly repayment. She was able to focus and concentrate on rehabilitation and getting back to work. And thankfully now she's back to work on a phased basis, but she is back working. I don't think any of these slides are going to surprise you. You're all medical professionals. You're dealing with this every single day. But the biggest or most common reasons for long-term sick, so mental health and musculoskeletal are the two biggest claims, just over 50%. Cancer is 13%, neurological 11%, heart conditions are 3%, and all others is 17%. Like, you guys are dealing with sick people every day. You see the impact of being sick and possibly being off work long term. I don't know if you see the impact. I mean, we would obviously see the impact of people not having the income to meet their monthly repayments. But that, when people arrive in a hospital in an A&E, they walk out in the morning and they don't expect to be in A&E that night. They don't expect to be in the back of an ambulance. They don't expect to wake up with a really, really, really bad headache and suddenly they're off to A&E at 4 a.m. People don't plan for that. But what you can plan for is if it does happen. If you're unfortunate to get sick and you can't go back to work, income protection is the policy that we would certainly recommend. Okay. And the average age when first claimed is 42 years of age. Okay. Suffice to say, just very briefly, the sooner you take out these policies, the better. Obviously, the older you are, the more expensive they are. But worse still, the older you are, chances are that you might have a particular illness that won't be covered. Okay, so we would always recommend get the policies when you're young, fit, and it's more affordable. And then if and when the body starts to go south, the older we get, I say that to everybody, by the way, the income protection will kick in. Okay, so why do doctors and consultants meet with us? Okay, there's a whole host of reasons. But look, ultimately, we're financial planners. And our job as a financial planner is to make sure that you've got sufficient income now, you've got sufficient emergency fund, that if you were to pass away, your family are financially secure. If you get sick, your income is protected, that your money's working hard for you. That you're saving in the right places, that you've got education funds in place, that you're not putting too much into your pension. If you're not putting enough into your pension, should you put more into your pension? We focus on things like wealth management. We find a lot of doctors are quite wealthy. But because you're so busy and you're on wards and you're dealing with patients, trying to manage that wealth or finding the time to manage that wealth can be sometimes difficult. And that's where I think we can really help you. We can obviously give advice on income and tax planning. We said we'll navigate the standard fund threshold. Absolutely, that's a given. That's one of the first things we have to do, which is so important. And we'll talk to you about private income if you have it. A lot of you will. Planning for retirement, financial independence in retirement. Estate planning is a big thing. Do you think your children are going to face or are going to incur quite a large tax bill? You've worked really hard. You want to get your children on the right footing, and you find out that the government are going to take a huge chunk of the estate that you worked hard to build up. Well, there's ways and things you could do to try and mitigate that tax bill. Or indeed, if any of you on the call, sorry, if you are coming into a large estate, or you think you're going to come into a large estate in the next 5 to 10 years, have a chat. We'll talk to you about what your options are. We can manage investment portfolios as well. We can talk to you about preserved pensions, education funds. And the last thing is navigating complex financial decisions. You guys are obviously navigating very complex health decisions in your field. Well, we can navigate and try and work with you to navigate complex financial decisions. So again, the QR code is there. We're going to contact everybody by way of a thank you and to answer any questions that you have. But I certainly encourage everybody to sit down and do the review. We will typically do them on Zoom or Teams, whichever suits. And I would encourage you to do it on a day off, because the meeting could be an hour, possibly an hour and a half if you incorporate a spouse. And there's zero chance of you being able to sit in your office on a Tuesday morning when your patient's outside doing a financial review with your spouse for an hour and a half. So again, we'd encourage you to do that on your day off, but we'll arrange that during the consultation. Or sorry, during the 5-minute phone call. I'm going to come back on a couple of minutes and answer any questions you have. At this point, I'm going to hand you over to Ryan Flood, our mortgage advisor. So Ryan, without further ado.
Sure. Thanks for that, Carol. So my name's Ryan. I'm the mortgage manager here with Irish Pensions and Finance. So generally, one of the things we look at is finance at a later stage when it comes to your pension, but we also want to look at what you're doing now to make sure you're optimizing where you're at. So we'd have a team of experts specifically tailored to kind of work with the public sector income. So your income is obviously a little bit different to the private sector. You have your salary scales, but obviously in your line of work, you're going to have additional incomes, whether you're working locum, consulting roles, or whether you're just getting a load of overtime coming into it. What we do is we have access to a number of different lenders that would be ideal for yourselves, depending on what your situation is. So with your salary scale, some will be able to go up your salary scale. Some will be able to lend longer. Some will be able to lend for different scenarios, whether you're looking to buy your first home, move, build, save and switch, or whether you're looking at the buy-to-let options then as well to build up a residential portfolio. With the one point of contact side of things, it's always beneficial. So you pick up your phone, you can get through to your mortgage advisor, or you can get through to your financial consultant. So it just makes it easier. That one phone call, you can manage everything. And the one-stop shop is more beneficial where you have the full financial plan. So as financial planners, your mortgage is a big one, because it's obviously going to be one of your biggest, if not the biggest purchase you make, and the biggest outgoing you're going to have each month. That'll bring me on to my next slide. So with yourselves, average mortgage among consultants will probably roughly around 750,000. So in this example, you're not doing anything different. All you're doing is changing provider to get a better deal for you, to make sure it's working as best for you. So switching from one provider for 3.5% that you're on at the moment, over repayment of about 3,300. If you switch it to the average market now, probably roughly around 3% is what you're looking at. You're saving yourself 205 a month. Annually, it's just under 2,500, all for doing the exact same thing, but you've already saved yourself 74,000 in additional interest. When someone like Kieran or Wendy comes into it, then they're able to help you find the best vehicle for that money, whether you want to put it back into your mortgage, build up your savings, your buffer account, or whether you want to redirect it into an ABC. So like if you went down the ABC route to maximize tax benefits, that 205 will change to your 342 over the standard moderate 6% return 30 years for the exact same thing you've been doing last month, whereas this month now you're building towards a 266,000 fund for your pension. So the whole point of this is more just trying to specialize on the public sector side, my knowledge in the mortgage market, and then Kieran and Wendy's knowledge on the finance side. It's just making sure it's working best for you. And that's it from me, Kieran. Thank you.
Great. Thanks,
Brilliant.
Ryan.
Thanks,
Right,
Ryan.
we have a couple. Thanks, folks. We're just going to be another minute or two. We'll say minute or two, maybe 2 or 3 minutes going through some of the questions. And again, that chat function is still there if anybody wants to. So we'll start off with the first question. Do I have to pay spouse and children's contribution on service on professional added years? If so, what rate is takeable from your lump sum? Okay, that's a great question, Andrew. So Andrew asks, if you're awarded professional added years, okay, now professional added years are gone for new entrants post 2013, just to make that point. But anybody prior to 2013, to take into account the amount of time it takes you to be qualified, you'd be given professional added years. But what happens is the amount that you would have paid by through your salary is going to be deducted out of your lump sum. I don't know what the exact rate is, Andrew, but suffice to say, any years that you were awarded, the spouse and children element will be deducted from your lump sum. Now, what's unfair in my opinion there is that that is regardless of you being married and or having children. So we do have clients that maybe never married or didn't have children. They'll get their 5 or 10 professional added years, and then X amount of money will be taken out of their lump sum to pay for other people's spouse and children. But the answer is yes, it will happen if you're awarded professional added years. I don't know exactly what the rate is, to be perfectly honest with you, but definitely that will happen. Joanne asks, I worked half my working life in the north and half in the south. Can you help sort that out? Yeah, certainly we can, Joanne. Yeah. We see that quite a lot, especially, you'll have border counties and stuff like that. But yeah, we absolutely can. I just actually, funny you should say that, actually, I spoke to a client who retired only today, consultant, and he had 20 odd years in the NHS and he had 22 years in the HSE. I was only speaking to him today. So there you go, small world. What's a day off? I have no idea. Can anybody help me out with that question? What's a day off? Oh, what's a day off? Sorry, as if you get day off. I beg your pardon. I beg your pardon. Yeah, who are you telling? Yeah, what's a day off? I hear you. I hear you. But look, the fact, and Wendy made the point, the fact that you were willing to put aside 40 minutes of Wednesday evening, you should all be commended. I don't mean to be patronizing because, it's not the most exciting topic. Let's call a spade, and we've all got busy lives. But again, when you're dealing with patients, you want to make sure that your patients are, you put a plan in place to make sure that they're fit and they're getting back on track. But we just want to make sure that you're financially healthy, if that makes sense. But yeah, what's a day off? God, who are you telling? Last one, I was in 1997 revision scheme pension from 23 to 2010. I then had a break from 2010 to 2013, from 2013, then moved to single scheme. I'm a consultant. How does that work? Yeah, okay. So basically, you'll be entitled to different pensions based on the different schemes. That's the short answer. Okay. So basically, this consultant has paid, or this doctor has paid into pensions in the various different schemes. Effectively, you will be paid pensions based on the different schemes you were on. We can figure it out and go through it with you. It is a little bit complex, and you'll have to go back and look at CV.
Quite common as well,
It's
Kieran.
very common.
Yeah.
Yeah, it's very common. It's very common. But again, it sounds like, someone in your situation would really benefit from a one-to-one, but it's very, very common. And again, I'd probably repeat myself. It is various different pensions based on the
For a lot of people, like I know some of these things that you come across, it's where to start. And I suppose this is something that we deal with day in, day out. Someone like the last person who had break in service and wondering what contract they're on, etc. This is something we come across day in, day out. So I suppose the first thing is having that conversation with ourselves, and we can help you navigate that.
Let's see if there's any more questions. Yeah, we have another question. Is an ABC PSA related to superannuation scheme or is it private? Well, it's not related to super. It wouldn't be deducted necessarily through. Well, it could be deducted through salary. Is it related to superannuation scheme? It may be. We'd have to have a look. We'd have to have a look at the scheme. We'd have to have a look at the scheme. There are PSA ABC schemes facilitated through hospitals. So it may be. We'd have to have a look at the scheme.
We have another one.
Oh, hello, Sinead. Are all consultants on the new salary of 40 years of service and on better scheme going to exceed the threshold? With 40 years service, I think you will. I think you will. Yeah, that's my opinion. Yes, but again, let's sit down, let's review it, let's do it the right way. Let's sit down and crunch the numbers, as it were. But I think if you're 40 years going on 270, it's highly probable that you're going to be over. I think, even at the 2.8. Now, you may not be, I can't say that as a matter of fact, but in my opinion, I think you're going to be very, very close. That's for sure.
Okay, I think we can call that a wrap, Kieran.
I think so, unless anybody has any more questions. Guys, it's going to be recorded. Thanks everybody for your attendance. It's very much appreciated. As I said, we'll all be in touch in the next couple of days. We won't be doing the 5-minute screening call this evening. You'll be pleased to hear, but we'll be in touch before close of business Friday, I'd imagine. And we'll take it from there. Thanks everybody for your attendance.
Thanks, everyone.